Good afternoon. This is Michael Kimmel, RPB's Executive Director, and I'm thrilled to welcome you to today's webinar that will focus on our move to daily valuation. Not only will we be explaining the new features, but we'll also give you some examples to illustrate how they work. Before we get into it, just a few housekeeping items. Next week, we'll be emailing to all webinar registrants a link to this recording and of the presentation and slide deck. And they will also be made available on our website. Also, you'll have an opportunity to ask questions at the end, so please hold them and we will certainly get to them during the last 15 minutes of the session. And to do so, all you need to do is click on the Q&A button and submit your question. We'll see them on our side. It's now my pleasure to turn it over to Len Teitelbaum, Chair of the Board, for a few opening remarks before we get into the market and plan update. Len?
Thank you, Michael, and hello. Unless something's changed in the last 30 seconds, I'm still the chair of the RPB, and it's a pleasure to be working with the staff of your pension fund. Now, in your board's continuing efforts to enhance and modernize the plan, we're pleased to talk to you today about the upcoming inauguration of the daily valuation format of your account. Just over a year ago, one of the most frequent requests from the survey of our participants was they wanted and needed to have account information in a much more timely manner. I am pleased to announce that this will be accomplished by the end of May. Now, as you listen to our webinar today, I'd like you to keep a few points in mind. Those are flexibility, control, both in investments and distribution. Importantly, there's no change in distribution policy, except you'll receive funds at the end of the month instead of the beginning of the month. Also, there's no reason to change excuse me, what you have been doing if you're satisfied with the current process, except now you'll be getting your information faster. One final point. As we have communicated to you several times recently, there's a blackout period that's mandated by our vendors so that the conversion can be implemented with as error-free as possible and without the need for post-conversion adjustment. While this will have a temporary effect on investment changes, it will not impact your distribution per se, other than you'll receive your distribution earlier than before. Now, this will be explained in detail later, and we encourage you to listen to it. I want to thank Alice Gunn, your Chief Financial Officer, who's been the leader of the team pushing this effort forward. Michael Kimmel, your Executive Director, who has been and will continue to be the spearhead of all our enhancements. Stephanie Berger, your Director of Marketing and Communications, for putting on these webinars and instructional material together. As Michael said, and I want to repeat for emphasis, you will be receiving information about how the implementation works, and we encourage you to please watch for these communications. Now, after a brief market outlook by David Baskin, who's Chair of the Investment Committee, we'll begin the introduction of daily valuation. As Michael said, this webinar and questions are being recorded and will be posted. Thank you very much, David.
Hold on. Gotta unmute David.
Secondly, can you hear me?
We can hear you.
Good. And secondly, how our plan has done in the year ending 2016 and in the first part of 2017. So I think, as we all know, that following the election in November, there was a good deal of enthusiasm in the market, perhaps surprising some, regarding the election of Mr. Trump as president. And that showed itself by a very strong performance in the North American equity markets, particularly in November and December. There was a view that the policies of the Trump administration would be very strongly pro-growth, particularly the very large infrastructure plan that he had talked about during his campaign, that the tax reforms would be easy to implement given a Republican Congress, and that the Obamacare, or Affordable Health Care Act, would be repealed and replaced with something somewhat more palatable to market participants. So as a result of that, as I say, the market was very strong in the latter part of 2016. The American dollar was particularly strong, rising particularly against currencies such as the Mexican peso, the euro, and the British pound. During 2017, in the first quarter, I'd say a mood of restraint or sobriety gripped the markets, and the views about the Trump administration policies evolved. In the first case, of course, Congress failed to repeal the Affordable Care Act and failed to replace it with anything. This raised the possibility that tax reform would not be so easy or straightforward as had originally been thought. And I might say that the proposal that was tabled yesterday does nothing really to temper that view, because the plan that was tabled is in fact not so much a plan as a wish list. There's been no progress on infrastructure spending at all. And making things even worse, there's been a lot of saber rattling in regard to North Korea, in regard to Russia, in regard to Syria. So all these things put together have dampened enthusiasm and had three real impacts. In the first place, the US dollar has been markedly weaker in the last 4 months. In the second place, US equities, at least until the last 3 days, gave up a lot of the performance from November and December. And the third and perhaps more subtle thing was that many market participants who felt that interest rates were rising inexorably changed their views, and in fact yields on things such as the 5 and 10-year US Treasury bonds reversed direction, and instead of going up, actually went down in March, a surprise to most people. So if I could see the next slide, please. One of the things that we try and emphasize to all of our plan participants is the impossibility of knowing in advance what segment of the market will outperform and what will underperform. If you look at what we call the quilt, for obvious reasons, and to borrow a metaphor from a different religion, the last were first and the first were last. You can see that in 2015, the gray square MLP's master limited partnerships, which deal with the infrastructure of oil and gas investments, was the worst performing asset class of 2015, and yet was the best performing asset class of 2016. And you can see that the worst performing asset class of 2016, shown as the peach colored square and noted EAFE, which stands for Europe, America, and Far East, this is the developed economies, was the worst performing asset class in 2016, but is the second best asset class so far in 2017, topped only by emerging markets, which had a decidedly mediocre performance 3 of the last 4 years. All of which is to say that wise investors diversify, knowing that they don't know what will happen next. Could we go ahead 2 slides, please? Thank you. This is the performance for the last 12 months of the 4 managed products available to our participants. The first, the Capital Appreciation Fund, the more aggressive offering, as you can see, had a fairly outstanding return, over 17% for the trailing 12 months, particularly strong also compared to its benchmark, shown in gray, at around 15.4%. The Appreciation and Income Fund, what we probably in the past would have called the Balanced Fund, also had strong performance at 12.3%, also beating its benchmark handily, which was under 10%. And finally, the Income Focused Fund, the conservative component of the 3 major parts, had a performance of 5%, beating the composite by 3.5%, largely because of non-traditional products that we had put into that fund. Finally, the Capital Preservation Fund, as you can see, eked out a performance of just over 1%, better than the benchmark, but nothing much to write home about. Could we go ahead again, 2 slides, please? Tier 2, which we introduced in the fall, consists of index-linked funds. That is to say, not actively managed, but very low-cost products, each devoted to a sector. Not surprisingly, as you can see, each of these products tracked their respective benchmarks very, very closely within a fraction of 1%. And as you can see, the best performing product in Tier 2 was emerging markets, just as it contributed on the quilt and contributed to our performance in the Capital and Appreciation Fund. It was the best performer in the Tier 2 products. So again, I think the message here is diversification is a benchmark, is something that we should all be doing, and it certainly paid off for all of our participants in the managed funds of Tier 1. And Lenny, that's all I think I have to say.
Thank you, David. And now we're going to transition into the next section of the webinar where David and I will talk about all the exciting changes coming with daily valuation. So first, what do we mean by daily valuation? Simply put, your accounts will be updated every day that the New York Stock Exchange is open. And we're going to talk a lot about what that means and how it gets updated with all the different features coming up next. First, in addition to more timely information, daily valuation will give you many advanced features that might be especially helpful for those who have market knowledge and or are comfortable with the markets, or who have a financial advisor who wants more flexibility with how you manage your money. First, you'll be able to make your changes to your investments more frequently. Second, you'll be able to control your how you invest your money and be able to differentiate between how you invest future contributions versus your current account balance. You'll also be able to transfer money between funds or amongst funds directly. You'll be able to control rebalancing frequency. And for retirees, for the first time, you'll be able to request distributions from specific funds. Now let's go through each one with some examples. First, let's start with more frequent investment changes. Previously, and you should all know this, you were only able to change your investments once per month. Now, you'll be able to change those investments once every 5 business days. Just understand that if you happen to make the change before 4 p.m. Eastern, before the New York Stock Exchange closes, the value of the fund will be based on that day's closing price. If you make the change after 4 p.m., the values of the fund or funds will be based on the next business day's closing price. Now, why every 5 days? A couple of reasons, basic reasons. First, to protect you and all of our investors from the potentially harmful effects of frequent trading and market timing, and also to keep transaction costs down. Now, in addition to the 5 business day rule, there's an additional rule with Vanguard for the Tier 2 funds. If you're moving money from a Tier 2 fund, any of the Vanguard funds, there is a 30-day rule which says that you can't move your money back into that particular fund for 30 calendar days. And we'll get into the specifics on that through a couple of examples. Also, I want to point out that you don't have to worry about tracking any of this. The system through Info Express will do all of this for you. We just want to make sure you understand what the rules are. Okay, first example, you're moving money from a Tier 1 fund, such as the Capital Appreciation Fund, to either, for example, the Income Focused Fund, which is Tier 1, or the Short-Term Bond Fund, which is Tier 2. Just have to wait 5 business days before you can make any additional allocation changes. next example, which really focuses on the Vanguard 30-day rule and how it applies moving money or shifting your allocation from any of the tier 2 funds into either a tier 1 fund or a tier 2 fund. So for example, if you have your money invested wholly or partially in the S&P 500 fund and want to shift to the total bond market fund in tier 2 or the capital appreciation fund in tier 1, you have to wait 5 business days, of course, because you've made an allocation change, but you also have to wait 30 days from that day before you can move any money back into the S&P 500 fund. So those two things run at the same time. So it's not like 5 days plus 30 days, it's 5 days with the 30 days built in at the same time. So very briefly to summarize this first change is to make an allocation change once every 5 days if you're moving any money around. But if you're moving money from a tier 2 fund to a tier 1 or tier 2 fund, it's just a 30 calendar day waiting period. Now we're going to get into rebalancing, which is a very important concept, and David will go through what that means and what your options are.
Rebalancing is the idea that if you set an asset allocation goal, you need to keep your eye on it in the light of changes in the market. Why might you want to do that? Well, say you've sat down with an advisor or considered this yourself and decided that the appropriate target for you is 75% equity exposure and 25% fixed income exposure. In November and December of 2016, what you would have found is that because of the very strong performance of the equity markets, your equity allocation probably would have crept up to 77 or 78%, and therefore be out of line with your goals. 2 or 3% doesn't make a big difference. But in the event that it got way out of whack, and in the example that Michael just put up on the screen, you can see that the capital appreciation allocation in this case grows from 70 to 78%. That's out of line with your asset allocation goals. And a principle of fund management is we shouldn't let the market change our goals. Our goals are our goals. So what we need to do is therefore rebalance, sell some of the capital appreciation, in effect taking some profits, move it back to where we want to be so that our assets are distributed as we want rather than as the market dictated through its strong increase. So if we could look at the next slide. With daily valuation, you can now do this more often. I would urge against doing this every 5 days. I think that's a little bit hyperactive, but certainly this is something that prudent investment counselors look at probably on a quarterly or at least semi-annually, and that's something that you should do yourself. You can ask us to auto rebalance for you. And in fact, the default position for the RPB is to auto rebalance on a quarterly basis. You don't have to ask us. Once we know what your asset allocation preference is, we'll turn auto rebalancing on and it will simply happen for you.
And in fact, David, let me jump in just to clarify. In fact, today, and it has been the case for a number of years, we auto rebalance everyone's account on a quarterly basis. And when we move into the daily valued environment, that will be the default.
That's correct. So that's, if you tell us nothing, we'll just leave daily rebalancing on and this will happen for you automatically. But note that what happens with the increased control you have with daily valuation, you can start moving funds around. And you may find that you have set your asset allocation differently than the RPB believes it, and it will rebalance you automatically unless you ask that that not be done. So that the other edge of the daily valuation sword is that you have to be careful about how rebalancing works. If you're a tier 2 investor and you have all of your money in tier 2, and particularly if you're taking advantage of the opportunity to change your investment focus more often, then probably you're going to want to change your rebalance and turn it off. But if you are, as most participants, largely invested in tier one, but perhaps you have one amount in tier two, my suggestion is that you will probably want to leave auto rebalancing on. Michael, is that how you see it?
That is correct. And just one other thing to remember, of course, this only matters if you're invested in more than one fund. Most of our participants actually are only invested in one fund, and there's nothing to rebalance to because that's the only fund they're in.
Right, that's exactly correct. So I hope everybody understands that. Now, the next way that balancing comes into play has to do with contributions you make on an ongoing basis. If you think about it, if you are, for example, 70% in capital appreciation and 30% in another product, you want your future contributions to be invested in accord with your current allocations. But you don't have to do that if you don't want. Say, for example, that you are 70% capital appreciation, but for whatever reason, you feel like you would rather be 80%. Well, you could sell another product and buy more capital appreciation, or you could simply direct that future contributions go only into capital appreciation until you've changed your balance to where you want it to be. In other words, there's more flexibility in how you use your future contributions. They're no longer locked into an old balance. You now have more flexibility, and you can tell us how you want that to go ahead. Again, a two-edged sword, and we would urge participants to think carefully about how they're doing that, because if you forget, for example, you could look at your statement in 6 months and find that it's not what you had expected or hoped. So all of these options come with added power, added capabilities for participants, but as with most things in life, with added power comes added responsibility. And what I would suggest is if you turn rebalancing off, you have to spend more time paying attention, understanding what's happening with existing money and with new contributions. Now let's talk about the ability to transfer money from fund to fund to change your asset allocation. Michael talked about the 5-day and the 30-day rules. If you're moving money between funds, again, if you don't turn rebalancing off, you'll find that you haven't achieved very much. This is for people who want to manually shift their asset allocations to meet their objectives. So you can see in the example that Michael's just put up on the board that this participant wanted to move 5% from Fund A to Fund B and did so. You know, in the last seminar, I differentiated between two classes of investors. Those who buy a car with a toolkit in the trunk that they never look at, and those who buy a car and immediately open the trunk and look at the tools. I suggest that the ability to rebalance contributions and to transfer money on a frequent basis between funds with rebalancing off are for the tinkerers, for the people who want to use the toolkit and want to exploit all the different mechanisms that we've now given the participants in order to maximize their flexibility. So similarly, just as contributions can be tailored, Michael will tell you how distributions can be tailored.
Thank you, David. So as I mentioned in the earlier in the presentation, for the first time ever, retirees will be able to have more control over how they manage their distributions. Today, all distributions are taken proportionally from each fund or funds that someone is invested in. So as in this example, if someone has 32% of their account in capital appreciation and 60% in the income focused fund and 8% in the capital preservation fund. Whenever we process a distribution, it comes out proportionately from each fund. But now there's more control. And David will talk about one of the ways you can do that.
Yeah, so say that we've had a particularly strong performance in the capital appreciation fund. You might want to say, look, capital appreciation is really working for me. I'm going to take money out of the capital preservation fund where it's only making 1%, and I'm going to direct the RPB to take all my monthly distributions from capital preservation for a while. Well, of course, the result would be that your allocation to capital appreciation would rise and your allocation to capital preservation would fall. But I think what we would say is that you should understand why you're doing this. Is this a decision to change your asset allocation over time, or is this really a short-term thing because you feel very good about holding capital appreciation because the market's going up? Or is this because you need perhaps short-term cash for a certain project or a certain need? We would caution participants against trying to time the market by varying the source of their distributions on a monthly basis. History has shown that very few people, including people who are market professionals and spend all day, every day, can do that with any success. More likely what you'll find is that you're taking money from where you don't want to take it and screwing up your capital allocation and leaving things in the wrong place. So it's a tool available to you. Again, diversification should be your primary goal, and making sure that you don't inadvertently change your asset allocation by having a short-term market view. Okay, next slide, I think.
Yeah, this is another example, David.
So this is just exactly the same example, but upside down. This is taking all the money from capital appreciation rather than capital preservation, maybe because you're nervous about the market, or maybe because you feel the market's done very well and you want to capture some of those gains by selling into a strong market. Exactly the same caveats apply, and it's obviously exactly the same principle.
Thank you, David. I'm going to wrap up and review all the features, but if at this point participants want to start submitting their questions, we'll start gathering them up so we're ready to go and respond to them as soon as we wrap things up. I see at this point we only have one question submitted, so I'm sure you all have some, so we'll be happy to answer them. Okay, so to summarize. I know this was a lot to absorb, but we're going to try to keep it simple. First, you'll be able to change your investments every 5 business days. Of course, there's the Vanguard 30-day rule. You'll be able to have more control over how you invest your current balances separately from your future contributions. You'll be able to make transfers between funds when needed. And for retirees, you'll be able to request to distribute your monthly distribution from specific funds. And then finally, you'll be able to decide how often you want to rebalance or to not at all, and let the market drive your account. New concepts for the RPB. These features are actually pretty common in most retirement accounts, but with our move to daily valuation, this gives us an opportunity to provide these new features for all of you. I also want to point out that we're going to be creating and preparing a user manual that will be made available once we come out of our blackout period towards the end of May. So if and when you want to take advantage of all these features, there'll be a step-by-step guide for you. So that's important for you to know, so you don't have to memorize everything we spoke about today. I do want to stress again that this presentation and the slides will be made available on our website, as well as emailed out, or a link emailed out to all of you. So you'll have access to it early next week when we can pull it all together. So that concludes our prepared remarks. And now we'd love to get into some questions. And I see that they're coming through.
I'm going to take the role of speaking about the questions or asking the questions, and then those who, either David, Michael, or myself, who feel best equipped to answer them can do so. I'm going to do it without attribution, and I'd like to get into one now. It looks like Tier 1 choices are managed funds and Tier 2 choices are index funds. What can we compare? Where can we compare fees and performance among these choices? Let me just add one thing. When you look at the performance and relative to an index, our numbers are after fees, and the index is without fees. So when comparing, as we did under our managed accounts, we outperform the index by almost 200 basis points. It's the benchmark index, excuse me. We definitely have done better because our outperformance is after fees. I don't know if that answers that part of the question. Michael, would you want to add anything?
Sure. So in terms of our fees and performance, all the fees are posted on our website. They're accessed through the investments tab. And as well, so you can find them a couple of ways. We post them directly on our website, and they're also accessible through all our fund fact sheets. The fees as well as the performance are all reported there. One of the things actually we didn't talk about specifically, because it's a bit of a nuanced item, is that when we go live in the daily valued environment, inside Info Express, we will now also be reporting on the performance of all of the funds. So that, I hope that answers that question.
One of the persons said that they came in a little bit late, but is unsure of the difference between Tier 1 and Tier 2. David, can you give a Reader's Digest answer to that one?
Right, and let me say, Rabbi Zeplowitz, that my dad says hello. The difference is this. Tier 2 are products that we added recently that give the participants the opportunity of building their own portfolio. Tier 2 has specific products, for example, large American stocks or emerging market stocks or bonds, short bonds or medium bonds. It's a do-it-yourself approach characterized by passive management. Each of these products is an index product with very low fees. Tier 1 consists of our traditional offering for managed, actively managed products that have active portfolio managers, somewhat higher fees associated with them. I can tell you, and Michael, you contradict me if I'm wrong, something like 92% of all of our participants' money is at the moment directed to Tier 1. This may be in part because we've only offered Tier 2 for a short period of time.
That is correct.
We have some questions concerning distributions, and let me try and combine them if I might. During the blackout period, can one withdraw funds in addition to the regular distribution that's been set up? And what is the real change coming about in terms of distributions, both at the minimum distribution and the monthly distribution?
Let me try to answer that. So during the blackout period, we will not be able to process distributions during the time we're in blackout. So we enter blackout on Monday. The plan is to come out of blackout during the week of May 29th. During that time, we will not be able to process partial lump sum or one-off distributions. As far as minimum required distributions, the actual required minimum distribution information actually is on our website, and it's only for those who have attained the age of 70 and a half and are retired. So if you're working and you're 72, you're not required to take minimum distributions. There's a whole bunch of specifics around that. A lot of that can be found on our website.
Let me just also try and clarify. I think you were going to give an extra distribution, are we not, so that those who are retired who are looking for a monthly distribution will not be without a monthly distribution during the blackout period.
That's correct. The monthly distribution process, the blackout period, we process monthly distributions before we went into blackout and after we come out of blackout. And so the folks that are retired and are receiving monthly distributions, they'll see no change to, they will not go without any payments. However, the one switch, and Len, I think this is what you're referring to, that we needed to make is that because of daily valuation, we needed to switch the monthly regular payment from the beginning of the month to the end of the month. And in order to not to affect people's cash flow, for the month of May, we're going to send 2 distributions. So they're going to receive one beginning and end. So that will be the case. For those, that means they'll, unless they tell us otherwise, they'll receive 13 payments. Of course, we can stop one of those payments if they want us to. This was all communicated to all retirees via a letter and an email that was sent to each person.
What happens to funds deposited into my pension fund by my congregation? And if it happens to be deposited within the 30-day waiting period triggered by a prior transaction, I might have. I think what they want to find out is, when will the money be invested? And what happens to the money that's been sitting around waiting to be invested?
Okay, so I think I could probably best answer this question. We worked very hard with the congregations and communicated personally to minimize any payments received during the blackout period. There were some congregations that had scheduled payments after the blackout period. We worked with them to push up those payments so we received them beforehand. Of course, that's not to say we may not receive a payment during the blackout period. Those payments we will process and record to their accounts once we come out of blackout, but it won't be until until into June because of the way we had to value people's accounts. So there should be minimal impact on the people who were still receiving contributions because of the work we did to communicate directly with the congregations or the employers.
It seems that the fees that are now being billed to us and deducted from our accounts, why have these charges not been shown before? And I'm not exactly sure you understand the question.
Okay, so I think the question has to do with the administrative fees. Previously, the administrative fees were not broken out on the statements. We started working with our record keeper to break those out a few months ago. They were always charged to people's accounts and reflected, I believe, in gains losses on the statement, but we now wanted to improve the reporting. And so I think it's been 3 or 4 months since we've broken out the fees that people see.
A question about, is any of this available through an app, or is the web interface our only point of access? Can I monitor my RPB balance through Mint or Quicken or similar? And do we have instructions?
So this is Michael again. Right now, the web interface is the main point of access for your accounts through Info Express. I can talk about Mint. In fact, I use Mint and was able to add RPB or Alaris, because they're the record keeper, to my Mint. So I was able to actually use Mint. I would guess if Quicken works the same way as Mint, that you should be able to add it to your account.
The performance versus the benchmark's important to me. Also, the quilt is important. Can we get the benchmark and the quilt on a quarterly basis?
Yes. In fact, the benchmarks, we report our performance against benchmarks every month. And certainly we can provide an updated quilt on our website to show and again, the quilt is a general asset class performance that doesn't reflect our RPB's performance. Those are general asset class performance, relative performance, of course. But yeah, that's something that we can provide.
A question come up if either or both could clarify if and when retirees can transfer assets between funds.
I'll give that a shot.
And David, if
And
you
David,
want
if you want to
right.
chime in. So for the transfer assets between funds function is available for everybody, whether you're retired or not. So it's not something that retirees or is limited by. What to remind people, what is in addition special for retirees is they can specify the funds from which distributions are taken. So that is something that is unique for them.
Another question on fees has come up. Wants to know, are they the same for tier 1 and tier 2?
I think we should, it's David speaking for a minute.
Okay.
I think we should make it clear that there's two kinds of fees. There's the actual investment management fees charged in the case of tier 2 by Vanguard for administering the index funds. In the case of tier 1 by the various fund managers the RPB employs to invest on its behalf. So those are investment management fees. On top of those, there are investment administration fees that the RPB charges to run the office and run the plan. And obviously the fees in tier 1 and tier 2 for investment management are quite different. And tier 2 is undoubtedly less expensive than tier 1. But Michael, if I'm not mistaken, everybody pays the same investment administration fee.
That is correct. That is correct. And again, I would refer people to our website for the details on the tier 1 fees and the tier 2 fees, so they can understand the differences.
Will retirees be able to manage or change the amount of their monthly distribution from the website?
Right now, the answer is no, and for the foreseeable future, the answer is no. The way in which retirees request changes is to simply send us an email, and we will make that change for them. As we look to further automate our processes, there may be an opportunity to do it, but we're still really in the investigative stages for that.
I think I understand this next question. Can you explain what still working is for the purpose of the required minimum distribution?
I'm sorry, Len, I have to giggle only because that's a question we do get often. And so unfortunately, IRS has not defined full-time or working. What we are advising people is that if you're working 5 days a week or 4 days a week, it's safe to say you're working and there's no required minimum distribution required. If you're working 3 days per week, it gets kind of muddy and unclear. If it's a 1 or 2 day a week situation, you're working part-time, a couple of hours here, a couple of hours there, that really is considered working, not working and retired, and RMDs should apply. I will always advise people to talk with their accountants when it comes to these kinds of questions.
There's one question here regarding what the opinion should be of an equity fixed income mix of investments as we age. How should we change it? Sounds like the old 120% rule. But though it's been suggested we take a more conservative approach as we get older and move investments to bonds. Should we in fact realize that we can use a formula such as 110 minus age as percentage of assets invested versus the old formula of 100? I'm not sure where, let me not offer an opinion. Michael or David, do you want to?
Yeah, let me step in on this one. So when I started in this business about 35 or 40 years ago, there was in fact a rule of thumb that said that as people got older, they should have more of their money in fixed income and less in equities. And the rule was that the percentage in fixed income should more or less be equal to your age, so that a 70-year-old would have 70% in fixed income and 30% in equities. Let me say that that rule was formulated in the period between 1948 and 1980, when interest rates in North America in particular were quite high compared to the long-term norm. And in those days, a retiree could perhaps expect to receive 5 or 6 or even 7% from fixed income holdings. Quite different from the situation today where fixed income, US government 10-year treasuries are yielding around 2.4%. I would suggest that for most participants, if they followed that rule of thumb, they would find themselves in short straits during their retirement. Most planners that I know, and certainly at our firm, have thrown that rule out the window and recognized that in a period of very low interest rates, and you can certainly see what the Capital Preservation Fund is earning, that it's inappropriate to have that percentage in fixed income. Now, that being said, this is a self-directed plan. It is not our role, nor are we permitted to advise you in that regard. You must seek your own counsel as to what percentage is appropriate for asset allocation. We're making a lot of tools available to you, including educational tools, to help you make that decision.
I started just a little ahead of David. I started in 1967, but actually 64, actively, while it was more corporate investment banking type work. We did get into this. I think it's very important to note, as David said, and let me repeat for emphasis, the amount of return that one can get out of the fixed income market is terribly different from what we've had in the past, number one. And number two, the variety of products being offered today is monumentally greater and exponentially greater than what existed when some of these rules were put into effect. So please take all those facts in mind and recognize the change that has happened. Quite in here, taking monthly minimum distributions, and I don't want 13 of them in 2017, I only want 12. Please advise and help. I think, Michael, you did answer that during the presentation, but maybe we ought to repeat it.
Yeah, I'll remind people, absolutely. So basically, it's pretty straightforward. Just send us an email, and we will stop your payment for 1 month, and it'll go back to 12. But we do want to make sure from a cash flow perspective that we do get you both of those payments in May. But if you want us to stop June or July or August, just send us an email.
Okay. I just want to make a brief interjection here. We recognize that not all investors are built the same or have the same goals, interests, and abilities. And what we've tried to do here is, I hope you can see from, especially from David and Michael's presentation, that what we've done is, as we've said, put a lot more tools in the toolbox. And if you don't want to do anything, there's nothing you have to do. And I can't emphasize that point strongly enough. If there's things you want to do, as indicated by our survey, we think you now have the tools to do it. Let me get back to the questions. Wanting to know whether we continue to break down all expenses and fees, even though the Trump administration will be changing the rules requiring the breakdown. We do that.
Well, we do break down the fees, the administrative fees we break out. Investment management fees, and this is standard industry practice, are rolled into the value of your account. So they're deducted from us before we credit your account with the gains or losses for that particular time period. Of course, we will tell you what those fees are through our reporting, through the fact sheets and on our website. I don't believe we anticipate changing how we do our reporting, regardless of what the Trump administration does or doesn't do. And it's actually not totally clear about what they're requiring at this point in time. Of course, we pay very close attention to what the laws are and what we're obligated to do and what we believe is the right thing to do. And our goal always is to do the right thing by all our participants.
And I want to emphasize the board feels very strongly that what we can do is beyond what we are legally required to do. We want to be responsive to what you need. And we have tried to do that. I think one final question here in our time allotment. Who is our plan administrator?
So our
Is it Vanguard? Was the
Vanguard,
question.
oh, right. So Vanguard is not our plan administrator. Alaris is our record keeper. So Alaris's job is to track all of the records for all of you, all of our participants. We work obviously very closely with Alaris, and in conjunction with our some other vendors, Northern Trust, which is our custodial bank. Gets a little technical here, but Vanguard is not our administrator of any kind. We happen to offer Vanguard investments, but they're not the administrator of the plan. The administrator of the plan actually is the RPB, working with our various vendors, Alaris, Northern Trust, etc.
I think what I would like to do is throw in really, it's not a gratuitous statement at all. The move to daily valuation was, the only word I can think of is arduous. Trying to get all the various factors running together in the same way in countless meetings while not missing a beat behind the scenes. That effort, especially by Michael and especially by Alice, I don't think can be underestimated. They did it without complaint. They did it by working a lot of nights away from their families. And I think that you as participants should know that this is a very, very serious undertaking by them. And I thought they did a hell of a job. Let me just close with a few remarks, if I could. I spoke about an agenda in my opening remarks to this webinar. And it was just a year ago, last January, everybody says it's too aggressive. Well, it's close to being completed. I'm very happy to say, and again, thanks to the staff that works here. Now, there's two more enhancements that I and your board would like to see implemented. And aspirationally, I wish it were yesterday, but realistically, it's probably by year end. We've had some questions on it, and I don't want to get too far ahead of myself. I don't want to sound like Sean Spicer either. But one of the things, I'm sorry, Michael just hit me so hard my glasses fell off. But I think what's important is that there are some more things that we want to do to make sure that you get a plan that you can not only invest in with great trust, but also the services that come with it. So again, realistically, thank you, Michael. Thank you, Alice and Stephanie, for your considerable efforts. And as always, we'd appreciate your feedback so we can make this time that you spent here significantly more productive. Michael, say goodbye, Michael.
That was a great segue, Len, because just as a reminder, we're going to be sending out a quick survey. We really would appreciate you completing it. We really need your feedback to make sure we're doing what we do as best we can, and we want you as part of that process. Just a couple other quick reminders. We'll have our full blackout the week before we go live. We're anticipating that to be the last week of May, but we'll communicate with you and let you know. We'll let you know when the blackout begins and when we're live and we're out of blackout. So rest assured, we'll keep you up to speed on everything going on. Keep an eye out for emails, etc. Exactly.
Check our websites.
Check our websites. We're constantly updating our We'll be updating our website with that information as well. Again, it's been our pleasure to talk with you this afternoon. Thank you for some very thoughtful and insightful questions. Hopefully, we've answered them to your satisfaction, and we'll talk to you soon. Take care.